Retail investors are busy lapping shares with both hands. No wonder their holdings in stocks on NSE have swelled to an all-time high of 7.18% in the June quarter of financial year 22. Lack of better avenues of investments, higher disposable income, underperformance of mutual funds, global market support, high liquidity are some of the reasons that are propelling investors to street. And the signs of this frenzy are visible all over, be it in the rally in penny stocks or hefty subscriptions for IPOs. Although this week was an anomaly in the bigger scheme of things. The four IPOs that opened this week, Car Trade Tech, Nuvoco Vistas, Aptus Value, and Chemplast Sanmar, together garnered only a third of retail applications compared to last week. Analysts do believe investors are treating work from home as a trade from home opportunity. But an old adage says, excess of everything is bad. So, is this case true for retail investors' participation too? Or is the new breed of retail investors are smart enough to skip the common potholes of investing? Let's find out. What's concerning about retail participation in the market?
Now, retail investors account for 45% of the cash market transaction in India. They're simply going up. Foreign portfolio investors who represent the smart money. Retail investors represent the new money. FPI represents the smart money. And this new investors, retail investors, now account for 45% of the cash market transactions. And that is one of the reasons why there is this enthusiastic retail participation. It is wrong to assume that this will continue. If there is a market correction, well, it can quickly impact on the retail investors. But from my experience in the market for more than 3 decades now, I have observed two things. One, retail investors jump onto the bull bandwagon. They start investing in the market when the markets are at its peak and the valuations are very high. And when the market corrects and the valuations come cheap, they quickly exit from the market. Fear and greed play a very important role in retail participation. Retail investors, when they enter the market, they buy low quality stocks, not high quality stocks. They buy mainly small caps and mid caps. And when the market corrects, these small and mid caps will be slaughtered by a bear ambush. So that is two factors which are a little bit concerning.
I think India is a market where the retail penetration is pretty low. So I think from that perspective, it is a good positive trend that retail people are participating in the markets. However, their participation, I think, is more from the perspective of FOMO effect, which is fear of missing out, then a phenomena which is backed by fundamentals.
Is this leading to the creation of a bubble in the market?
The problem with bubble is bubbles cannot be defined. It is very difficult to define a bubble, and bubbles can be understood only in hindsight, right? But I can tell you one thing, and that is markets are overvalued, whether it is in US or Europe or in emerging markets like India, particularly in India, markets are overvalued. If you take the popular matrices of valuation, like for example, the market cap to GDP ratio, the so-called Buffett indicator, which Warren Buffett regards as the most important indicator. In India, the market cap to GDP ratio is now at 115%. The historical average is 77. The price earning multiple, the PE ratio, the historical average in India is around 16. Now we are trading at a forward PE of around 22, roughly more than 22. So valuation, if you look at the matrices of valuation, valuations are high, markets are overvalued. Overvaluation should be an indicator of caution ahead. Retail investors should be cautious while investing aggressively, particularly in small caps and mid caps at this range of valuation.
How are you analyzing the mad rush in the IPOs?
If we compare all the 31 IPOs which have come so far from December 2020, retail participation has been very high. So in 30 out of 31 IPOs, retail people have subscribed for more than 2 times of their reserve portion. In fact, in many of the IPOs, they have subscribed for more than 10 times, which shows that retail people want to actually grab at least one lot in the IPO, and hence they are going after every IPO. Probably by not looking at the fundamentals or long-term outlook of the company, they are investing in the IPOs just to make sure that they get handsome listing gains. I think this phenomena definitely is a cause of concern, because what happens is that when such kind of thing happen, there are a lot of companies which see an opportunity, and whether they have very strong fundamentals or growth outlook or not, they find the time to be apt for them to actually launch IPOs. And if their IPOs are subscribed fully, retail investors would definitely get something out of it, and it may or may not result into good gains on listing, as well as it might turn out to be a very poor bet in long run as well.
Even borrow money and apply for IPOs. IPOs is fine. Retail investors participating in IPOs is good, but the retail investors should distinguish between good IPOs and IPOs which need not prove to be good in the long run. There is a study by Prime Database which says that 89% of the IPOs which came some how many years, 2006, so that means must be some 15 years now, the returns has been very poor. 89%, only 11% has delivered reasonable returns. So many of the IPOs in which the retail investors are now enthusiastically applying will result ultimately in losses for retail investors. So a very important point is retail investors should distinguish between IPOs and OFSs, offer for sale. Now, exploiting this exuberance in the stock markets, a large number of promoters are now exiting. Promoters will be making a lot of money, but newbie investors who are applying for this are likely to come to grief maybe 1 year, 2 year, 3 year from now. Therefore, they have to be extremely careful while applying for IPOs.
Why did retail investors give a lukewarm response to 4 IPOs that opened this week?
There were 4 primary market issues which opened in the week 9th to 13th of August, and all these 4 issues were of a much bigger size, between 3,000 and 5,000 crores. Further, each of these issues had their own sets of issues. For example, Nuvoco Vista was an issue of 5,000 crores, and it had made losses on account of integration, the merger of various group companies that were acquired, like, for example, Lafarge, and of course the Imami acquisition which was done, and they reported losses in 2 of the last 3 years. If you look at Sanmar, Chemplast Sanmar, in this case the company had acquired a subsidiary and made it into a wholly owned company, as a result of which the company had negative net worth. Compare this with the earlier lot of 4 IPOs which consisted of Devyani International, Exaro Tiles, Krishna Diagnostic and Windless Biotech. Here the size of issues were much smaller, with just Devyani being about 1800 odd crores. The remaining 3 were substantially lower, and the total amount to be raised was about 4600 crores. Here you had much larger applications that were received in the IPOs than the present lot. If one tries to understand, was there any shift in the understanding of the retail investor, not quite sure whether that is reality or it is just a fatigue factor, because the pressure of IPOs has been very high, and you had issues opening every single week, and the irony of it was that in the previous week you had 4 IPOs opening on a Wednesday, closing on a Friday, certainly bringing in fatigue factor and also reducing the availability of funds for investors to apply irrespective of whether they were HNIs or they were retail investors.
Are the new breed of retail investors not as gullible as assumed?
So far, investors have been applying for IPOs only on the basis of getting lucky, allotted shares, and they are able to encash with substantial premiums on day one. Going forward, while this particular lot of IPOs has seen substantially muted response, whether this would be the norm or not would be determined once the 4 issues list on Monday from the previous week, and these 4 issues list in the following week. Post the performance of these 8 IPOs, 4 plus 4, and the performance of these newly listed IPOs in the June quarter results, will we know how these companies have actually fared. The separation of the chaff from the wheat would only then happen. I believe it's still early days, and we need some setbacks to this new breed of retail investors, which from that typical 25-26 lakh applications per IPO has now crossed the 32 lakh mark, and we do see between 35 and 36 lakh applications also hit in a particular issue.
USA and Chinese markets have much higher retail participation. Shouldn't the push be to bring more investors to Dalal Street?
Retail investor participation in the capital market is desirable. That is actually one way of democratizing the wealth creation that happens through the stock market. In the developed countries, retail investors are far more financially literate than the newbie retail investors who are rushing into markets like India right now. So the financial literacy is a very important factor. So retail investors, before putting big money in the stock market, they should first learn the basics of stock market investing. That is very important. Ideally, a vast majority of them do not have the expertise to invest in the market directly. So ideally for them, investing through the mutual fund route, particularly through the systematic investment plans, would be good for them. Daily dabbling in the market, day trading in the market, speculative trading in the market would be hazardous for financial health.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com.